Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the inner workings of automated trading systems for MetaTrader 5. Today we're taking a close and careful look at an expert advisor called Channel Latch Trend Flip. This is a trend-following approach built around a two-line price channel and a single latch regime signal. Over the next several minutes, you'll learn how it defines a market channel, how it decides that a genuine trend change has occurred, and the 3 filters it applies before signaling any trade. Remember, this is educational information only and not financial advice. Let's begin. Let's start with the big picture. Channel Latch Trend Flip belongs to what traders call the channel family of systems. At its heart are 2 lines drawn from price itself. The upper line is a simple moving average of recent highs, which acts as a moving resistance baseline. The lower line is a simple moving average of recent lows, which acts as a moving support baseline. Together, these 2 lines form a channel that breathes with the market. Inside that channel sits the idea that gives the strategy its name, the latch. Think of the latch as a memory switch that remembers which regime the market is in. It flips to an up regime only when a bar closes above the upper baseline, and it flips to a down regime only when a bar closes below the lower baseline. As long as price is chopping around between the 2 lines, the latch simply holds its previous value. This hysteresis, or holding band, is the whole point. During a sideways range, the close bounces back and forth between the baselines, and because neither line is convincingly cleared, the latch never moves and the strategy stays flat. That helps the approach avoid being whipsawed in choppy conditions. A flip of the latch is therefore meaningful. It only happens when price genuinely leaves the recent high and low envelope. But the strategy does not blindly act on every flip, because even a real flip can arrive at an awkward moment. So it layers 3 additional filters on top, which we'll walk through shortly. In terms of who this is built for, it's aimed at traders who are studying systematic, rules-based trend following on liquid major currency pairs, such as widely traded euro or pound pairs, typically on the 1-hour to 4-hour time frames. It's a single position system that takes 1 trade at a time and manages risk with volatility-based tools. As always, trading carries risk. Losses are a normal part of any strategy, and nothing here is a recommendation. Now let's walk through the exact logic step by step. On each newly closed bar, the strategy recalculates the 2 channel baselines and reads the average true range, a common measure of volatility. It then checks where the just closed bar finished. If that close is above the upper baseline, the latch is set to the up regime. If the close is below the lower baseline, the latch is set to the down regime. If the close is between the 2 lines, the latch holds whatever it was before. When the latch changes value, we call that a fresh flip. A fresh flip alone is not enough. Before the EA will signal a trade, that flip has to clear 3 gates. The first is the slope regime gate. A slow exponential moving average, the trend line, is compared against where it stood a few bars ago. For a long, this slow average must be sloping upward. For a short, it must be sloping downward. This keeps the strategy from taking flips that fight the broader trend. The second gate is the decisive break. The flip bar's close must clear its baseline by at least a set multiple of ATR, defined by the BreakAtrMult multiple parameter. This rejects marginal pokes just over the line and only accepts breaks with real conviction behind them. The third gate is the with trend body. The flip candle itself must close in the direction of the trade, meaning a bullish body for a long and a bearish body for a short. The candle has to agree with the signal. When a fresh up flip clears all 3 gates, the EA signals a buy. When a fresh down flip clears all 3, it signals a sell. Only 1 position is held at a time. Risk management is layered. Every trade is placed with a stop loss and a take profit set as multiples of ATR, so they adapt to current volatility. There's a break-even ratchet, which pulls the stop to the entry price once the trade has run a defined ATR distance in favor, so an advanced winner is protected. And there's a regime change exit. If the latch flips to the opposite regime while a trade is open, the position is closed immediately, and the system may even reverse into the new regime on the same bar. Structure, not just the stop, bounds the risk. Let's read the actual meta editor code on screen. At the top are the input parameters. ChannelPeriod, defaulting to 20, sets the lookback for the high and low baselines. TrendPeriod, defaulting to 100, is the slow moving average that defines the tradable trend, and slope lookback measures its slope. BreakATR multiple, defaulting to 0.25, is the decisive break margin. Then we have the ATR period, the stop loss and take profit multiples, the break-even distance, the fixed lot size, and the magic number that tags the EA's own trades. Now the two signal blocks. The long setup is true only when four things line up together. There's a fresh up flip, the slow average slopes up, the close clears the upper baseline by at least the break margin, and the candle closes bullish. When all four agree, the code calls trade.buy. Notice how the stop loss is placed below the entry at the ask minus the stop multiple times ATR, and the take profit above it at the ask plus the target multiple times ATR. The short setup mirrors this exactly. It needs a fresh down flip, a downward sloping average, a close below the lower baseline by the break margin, and a bearish candle. Then trade.sell is called, with the stop placed above the entry and the target below it, both scaled by ATR. Both sides are symmetric, and both let volatility size the risk. Let's bring this to life on the chart. You can see two lines drawn over the candles. The blue line running across the tops is the upper baseline, the moving average of recent highs. The green line beneath is the lower baseline, the moving average of recent lows. Between them sits the channel, and this is where the latch quietly waits. Look at the first few candles on the left. Price is drifting sideways, with each close landing between the two baselines. Notice that neither line is convincingly cleared, so the latch simply holds. The strategy does nothing here, and that is by design. This is exactly the kind of chop the holding band is meant to sit out. Now watch the fifth candle. Price pushes up with a strong bullish body and closes clearly above the blue upper baseline. This is a fresh up flip of the latch. But before signaling, the strategy runs its three checks. The slow trend average is sloping upward, so the slope gate passes. The close clears the upper baseline by more than the required ATR margin, so the decisive break gate passes. And the candle body is bullish, agreeing with the direction, so the body gate passes. All three align, and the buy entry marker prints on that breakout candle. The stop loss is placed below the entry at a set ATR distance, and the take profit is set further above at a larger ATR distance, giving a reward to risk plan built from volatility itself. Follow the next candles as price extends higher, one bullish bar after another, climbing away from the channel. As it advances the required distance, the break-even ratchet pulls the stop up to the entry, so the open trade is protected against giving back its early gains. Price then reaches the take profit target marker, and the long trade is complete. Notice how the entry made sense because price left the recent high envelope with conviction and the trend agreed. Now the market changes character. After the peak, the candles roll over and begin printing lower. Price slides back down through the channel, and the closes start pressing toward the lower green baseline. Watch the 11th candle in the sequence. It closes with a bearish body clearly below the lower baseline. This is a fresh down flip of the latch in the opposite direction. Again, the three gates are checked. The slow average has turned lower, so the slope gate passes. The close clears the lower baseline by more than the ATR margin, so the decisive break gate passes. And the candle body is bearish, so the body gate passes. The sell entry marker prints. For this short, the stop loss sits above the entry and the take profit sits below it, both scaled by ATR, mirroring the long side exactly. Price then works its way down through the following candles, making fresh lows, until it reaches the lower take profit target and the short trade closes. Had the latch instead flipped back up while this trade was open, the regime change exit would have closed it immediately, and the system could even have reversed. Candle by candle, you can see the pattern. Wait inside the channel, act only on a convicted break that clears every gate, then let ATR-based risk management do the rest. So there we have it. Today we explored Channel Latch Trend Flip, an expert advisor that builds a channel from moving averages of recent highs and lows, uses a latch to remember the market regime, and only acts when a fresh flip clears three gates: the trend slope, a decisive break beyond the baseline, and a with trend candle body. We saw how it manages trades with ATR-based stops and targets, a break-even ratchet, and a regime change exit. Everything shown here is for educational purposes only, and is not financial advice, a recommendation, or a solicitation. Trading involves real risk, and losses do occur. If you found this analysis helpful, please like the video, leave a comment with strategies you'd like me to break down next, and subscribe for more MetaTrader 5 strategy walkthroughs. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.